Good evening, everyone. I welcome you all in this webinar on a very important topic, issues in taxation of partnership firms on dissolution and reconstitution. We have got Dr. Agarwal sir, Dr. Rakesh Gupta sir, and CA Somil Agarwal sir with us for the deliberation. I would now request Dr. Rakesh Gupta sir to kindly come in to introduce Dr. Agarwal sir and CA Somil Agarwal sir. Over to you, sir.
Thank you, Saksham. Today's webinar is pursuant to our quest to share whatever little we know with our fellow professional friends. There was a special request from Sri K.K. Singla ji of Patiala that there are several issues which are oozing out and emanating from the taxation of the partnerships as a result of dissolution and reconstitution. Therefore, we thought that we will hold one webinar. Today, I am with Dr. Raj Agarwal, my partner, who has authored 3 books. We both have authored 3 books: Search and Seizure, Real Estate Joint Development Arrangements and Agreements, and Black Money Law. Dr. Raj is a Chartered Accountant, Company Secretary, Cost Accountant, MBA, LLB, LLM, PhD, and he is Management Accountant also. And I tell you, today he has prepared one PowerPoint presentation, and which he would present it today and lead the discussion. And thereafter, we'll take up certain questions which may be left, though I believe that after his deliberations, not very many questions will be left unanswered. But let me begin by saying that there was a point of time when any transfer from the partnership firm or from the partner into the partnership firm would not have attracted any tax implications. And that was precisely for the reason that under the civil law, a partnership firm and the partners now are not treated as separate and distinct entities. Under the Income Tax Act, firm and partners have been made a different, distinct and separate entities. And that is how the questions of the taxability of such transfers now have started emerging. The very first amendment which came, if you remember, by the Finance Act 1987, by inserting 2 sections 45(3) and section 45 subsection 4. Section 45 subsection 3 now provided with effect from 1/4/1988 that any transfer of any capital asset by the partner as his capital contribution into the firm now would be treated as transfer, and fair market value, not fair market value, but the value recorded in the books of the partnership firm, that will constitute the sale consideration. Similarly, when the capital assets of the partnership firm used to be distributed amongst the partners on dissolution or otherwise, then the fair market value of that asset which was distributed to the partner now used to constitute transfer, and any profit and gain arising from such transfer now was made taxable under section 45(4) by deeming the fair market value of such capital asset as deemed sales consideration. But then again, lots of issues arose. Now, what is the meaning of distribution of capital asset? What is the meaning of the word or otherwise? Now, whether by revaluing the assets and crediting the partner's capital account, now whether it entails any capital gains tax implications, and therefore the legislature in its wisdom thought to rewrite the law completely. And that is how Finance Act 2021 introduced section 9B and section 45(4), and by making some changes in section 48 by inserting one clause in section 48 Roman 3I, and then CBDT on the basis of the delegated legislation Now enacted Rule 8AA, Sub Rule 5 and 8AB. Now I can say that the rules which have been framed under Rule 8AB and then the guidelines issued by the board on 2nd of July 2021. Now that makes a very interesting reading because the supposed hardship is sought to be mitigated by the board. So this entire gamut of the taxation of partnership firm as a result of dissolution and reconstitution now is going to pose a problem more so in view of the languages of section 48.3, in view of the board's promulgated rule 80AB and sub rule 5 of 8AA. So I would request my partner Dr. Raj Agarwal to kindly start his deliberations and then take us traverse through his PowerPoint presentation. Dr. Raj.
Thank you, Dr. Rakesh. Very good afternoon to all the distinguished participants and dear friends. The topic of discussion today, the taxation of partnership firms and of course LLPs by way of introduction of section 9B and 45(4)(a) of the Income Tax Act. So let me first take the provision of section 9B. In fact, after introduction of these two sections, there is a lot of queries or lot of concern in the minds of the people or professionals that to what extent there has been change in the taxation of partnership firms. As Dr. Rakesh has told that earlier there was no tax being attracted in case of admission or in case of retirement of any partner or readjustment or reconstitution of the partnership firm, whether any capital asset is given or any amount in excess of the capital balance of the partners is given to the partners. Changes have been made in the Income Tax Act time to time, and section 45(4) earlier, erstwhile 45(4) was brought earlier to bring into tax when any capital asset in kind is given to the outgoing partner, then its market value, difference of book value and market value was provided to be taxed. But again, there were a lot of questions, lot of concerns regarding the interpretation of various terms used in that section. But that erstwhile 45(4) have altogether been deleted. Now, instead of erstwhile 45(4), 9B has been prescribed. In fact, 9B has been prescribed as a substitute by extending its scope of the erstwhile 45(4), where any capital asset in kind is given to the partner who is the outgoing partner, then the fair market value of that particular asset has to be taken. Somil, would you please run the PowerPoint next slide? Yes, it is. Then the fair market value is to be taken in the hands of the firm as sale consideration, and capital gains tax shall be paid by the firm. So section 9B, now the extension is that not only capital asset, even stock in trade also, if it is given to the outgoing partner in kind, then the fair market value of that asset or stock in trade shall be taken, and it would be taxed. I mean, the gain, difference of the book value and the fair market value shall be taxed in the hands of the firm. So first of all, the applicability of section 9B is only when any capital asset in kind or stock in trade in kind is given to the outgoing partner. So this is the most important thing. If any amount is paid in monetary terms, then section 9B is not applicable.
It may not be
The
necessary for the
applicability of section,
Rajkumar. It may not be necessary for the partner to be outgoing, because on reconstitution, when there are change in the profit and loss sharing ratios, and if any capital asset is received or stock in trade is received by you in the existing partner, then also section 9B
yes.
would come.
I mean, outgoing I am using because generally the asset is given when partner is relinquishing his rights or is retiring. Otherwise, it is reconstitution, and reconstitution has been defined that what can be the situation where there can be reconstitution of the partnership firm. Either any partner is admitted, or any partner is going, or there is a reconstitution in the sharing ratio of the partners. In all the situations, if any asset in kind is given, only then section 9B is applicable. And the sale consideration for the purpose of taxability in the hands of the firm shall be taken to be the fair market value of the asset which has been given to the partner. Next. Somil, would you please keep on? Yes. So, first of all, section 9B, or for that matter, section 45(4)(a) also are applicable to whom? Partnership firm, LLP, along with that AOP and BOA also, association of persons or body of individuals. To them also these sections are applicable. So, I mean, in all the four entities which are falling in this category, this section may be applicable. In case of, as I just said, reconstitution of the specified entity, and reconstitution may be some partner joins or some partner leaves, or there is a change in the sharing ratio of the existing partners. In all the three situations, section 9B, or for that matter section 45(4)(a) may be attracted. But as I said, that the attraction of 9B is only when any asset or stock in trade in kind is given to the partner in the case of reconstitution. In case of dissolution, of course, 9B would be applicable, because when there is a dissolution of the firm, then all assets are distributed. If assets are sold in the market, monetary value is taken in the firm, and then monetary amount is distributed, then of course 9B will not be applicable. But if asset in kind are given to the partners, then the asset have to be transferred in at fair market value. So fair market at the time when asset in kind is given to the outgoing partner, then it is deemed as a deemed transfer. It is provided in the section itself that it shall be deemed as a transfer. Next. So, transfer of asset in kind to the outgoing partner to be treated as deemed transfer in the hands of the specified entity of firm. So that is the, in fact, charging section 9B itself, where it has been provided, and along with the capital asset, if inventory or stock in trade any item is given, then this will also be taken to be as deemed transfer, and fair market value of stock in trade shall also be taxable in the hands of the firm. If it is capital asset, then it would be taxable in the hands of the firm as capital gains. On the other hand, if it is stock which is being transferred to the partner, then it will be taxed in the hands of the firm as business profits. Moreover, when capital gain is being attracted, it can be short-term capital gain or it can be long-term capital gain. So if asset being transferred is a long-term capital asset, it may be long-term capital gain in the hands of the firm. If asset being transferred is a short-term capital asset, then it would be short-term capital gain in the hands of the firm. So next page, let us see what is the rationale of section 9B. So the rationale of section 9B is when any capital asset or stock in trade is given to the partner in the case of reconstitution, the difference of book value and fair market value asset is profit or gain to the firm, and it is taxable in the hands of the firm. So it is, if it is being given to the partner, it is at par as if it is being sold in the market, and therefore it is going to be taxed in the hands of the partner. A question comes कि why section 9B has been prescribed in chapter 2 of the Income Tax Act instead of erstwhile section 45(4), parallel to which this section has been prescribed. The reason is that the scope of this section has been widened. It is not only capital gains. Now, it is not only the transfer of the capital asset on which capital gains is attracted. Now, even the stock in trade, if it is transferred, then also there is a attraction of tax liability in the hands of the firm. Therefore, instead of providing in the chapter of capital gains as well as in the chapter of business profits, they have created or they have made the provision in chapter as a charging section in chapter 2 probably of the Income Tax Act, where a specific special section 9B has been given. So, instead of making the provision differently in both the chapters, new section 9B has been provided. So I don't think that as per the scheme of the Income Tax Act, there was any need or to provide a specific section, especially 9B under chapter 2. It could have been done in the chapter of the capital gains as well as in the chapter of the income from business or profits. But another reason may be that section 45(4) is now providing taxation of in the hands of the firm of any excess amount in addition to the capital paid to the partner. So if this section was also incorporated under the capital gains chapter, maybe it could have given the impression as if there is a double taxation. But in fact, I will discuss in later part. The two provisions of section 9B and 45(4) are with different intent, and we cannot say that there is going to be double taxation on the same thing by way of these two provisions. Next. So, if we look into the computation part of section 9B, then first of all, the sale consideration, because it is a deemed transfer, sale consideration shall be the fair market value of the capital asset or stock in trade. When if it is a capital gain, in that case, whether it can be a long-term capital gain or short-term capital gain, it will be decided by the asset which is being transferred. If asset being transferred is long-term capital asset, it would be a long-term capital gain. If asset being transferred or being given to the partner is a short-term capital asset, then it would be a short-term capital gain. Whether in the case of long-term capital gain, indexation shall be allowed. Of course, it will be allowed because the taxation is in the hands of the firm as a deemed transfer, presuming that this asset has been transferred to the partner at fair market value. So, if it is a long-term capital asset, then indexation shall be allowed. And even CBDT has issued a circular clarifying some of the points with respect to section 9B and 45(4)(a), and there also they have stated that indexation in case of section 9B, if it is a long-term capital gain, it will be allowed. Another question may come whether firm may be entitled to make investment or to claim deduction under section 54(EC). I think that shall also be allowed, because whatever the provisions, normal provisions of the Income Tax Act are concerned with respect to the capital gains, those all will be applicable in the case when capital gains tax is being attracted in the hands of the firm as under section 9B, taking the transfer of the asset to the partner as deemed transfer.
But then, Rajkumar, there are contentious issues on this 54(EC), because if we read section 54(EC), it refers to consideration received. So, whether this deemed receipt of the considerations can be said to be the actual receipt of consideration, that is one issue, and which may impede the way of 54(EC). Second, reconstitution 54(EC) I can understand, but in case of dissolution, when the firm will terminate at that stage, because 54 EC bonds will have to be retained for 5 years. So that may pose a problem for a dissolved firm to claim the benefit of section 54 EC. So that is, I mean, these are the two issues. But then, of course, the first issue, in case it is a deemed receipt or is the actual receipt, it should be taken as one, and 54 EC in case of reconstitution should not be any problem. That is my take.
Yes, yes. Next. Now, contentious issues. We have listed some of the contentious issues which may be interesting to be discussed.
एक राजकुमार, आवाज थोड़ा पास से बोलना पड़ेगा, आवाज उतनी साफ नहीं आ रही है.
Okay. So let us discuss some of the contentious issues which we have listed. Is it okay now?
Yes, better.
Yes. So one thing that section 9B has prescribed, that such transfer to the outgoing partner shall be treated as a deemed transfer. But the definition of transfer of capital asset under section 247 has not been amended. So whether that can make any issue, Dr. Rakesh, would you like to throw light on this?
Yes. In fact, in the context of erstwhile section 45(4), this used to be taken as one of the grounds when we used to agitate it. Unless you amend the definition of transfer under section 2 clause 47 of the Income Tax Act, now you cannot now bring it to the charging section by providing it under subsection 4 of section 45. Now this argument was repelled by court, and so much so, even in a very recent decision of the Supreme Court in Mansukh Dying, Honorable Supreme Court has said whether there is an amendment 247 or not, if 45(4) refers to transfer, there is transfer. So that controversy now is no longer any meaningful controversy.
Now, one more very interesting issue which is coming out by reading of section 9B, because the taxability as per section 9B arises in the year in which asset is received by the specified person. A specified person means outgoing partner or the partner in the case of reconstitution to whom asset is given. Now, there can be a situation when the year in which reconstitution of the firm is done and the year in which asset is given to the partner may be different years. So in section 9B as well as in section 45(4), the taxability has been prescribed in the year in which asset is received by the specified person. Now I am not able to understand that the concept of mercantile or accrual basis has been to some extent or in a manner has been diluted or has been deviated by these provisions. Because, for example, in a case of a partnership firm which is reconstituted where some partner retires as on 31st March 23, but the asset which is given to the partner maybe in next year, or it is not only the asset, it may be the amount also, amount which is paid maybe in the next year. In the case of amount, 45(4) will be attracted, 9B will not be attracted, but the question is common for both the sections. So there is a specific mention that the taxability is in the year in which asset is received by the specified person. I mean, to have the reconstitution in the some other year and to make it taxable in some other year does not gel properly with the scheme of the things. Whether a question may arise whether receipt by the partner has to be actual receipt of asset or amount, or it may be constructive receipt. Whether it can be said that on reconstitution, if as per the agreement in the partnership or amendment in the partnership or dissolution deed, it has been prescribed that such and such asset or so much of amount shall be paid to the partner. When there is a reconstitution, this provision will be made. Whether that provision would be in the nature where we can say that constructive receipt has been made and actual receipt may be in subsequent year of the amount or of the asset. but taxability may arise in the year in the reconstitution only. Otherwise, not to tax in the year of the reconstitution, but to tax it in the subsequent year. I would like to have the comments of Dr. Rakesh also on this issue. That what are his views? How and
Definitely.
how? Yes, yes.
And definitely, I mean, this is a very peculiar expression used by the legislature, that the taxability has been pegged with the receipt, and now it has got several facets. Like if the amount, or if the value of that asset is credited to the account of the partner, now whether that would be treated as good as the receipt by the partner or not, number one. Number two, if some stocks or capital assets are given in different years, then the taxability would be in different years. Now this is something very unique. And third thing, with this receipt is associated the receipt by the partner. So suppose if there is a dissolution, and that dissolution is as a result of the death of the partner, and it has been so prescribed in the partnership deed that on the death of the partner the firm will get dissolved. Now in that case, there is no occasion for the dead person to receive. Now the legal heirs will receive. Now whether the receipt of property by the legal heirs in their own capacity, now, because it cannot be said that it has been received by the dead person, nothing can be received by the dead person. So in that case, will there be no taxability under section 9b? Now all these things are there, on which I mean, we all will have to break our heads, but then these are very pertinent issues which Dr. Raj has raised, and let us see in what manner or what can be the reply to it.
So next issue, that this section is covering capital asset or stock in trade. There may be certain capital asset, there may be certain assets which are not covered within the definition of capital asset as provided in section 214 of the Income Tax Act. For example, agricultural land, or some other asset may also be there which is not covered within the definition of capital asset. In such cases, whether there would be attraction of section 9b or it won't be. This is again, this may be also be a question. In the case of rural agricultural land which is not covered within the definition of capital asset, one can certainly argue that it is not taxable. Therefore, there will not be any tax liability under section 9b for the partnership firm also. Rural agricultural land is not covered within the definition of capital asset, and it is not taxable also. But for that matter, if there are any other assets which are not covered, for example, I'm not, I mean, recollect any such asset, but Dr. Rakesh can also throw some light on this issue.
Yes, because the exceptions which are given from the definition of capital assets, the stark example which comes in our mind is rural agricultural land. You have rightly touched upon it. Since it is not capital asset, so any amount of rural agricultural land owned by the partnership firm given to the partner, outgoing or existing, that will not attract section 9b.
Then, as we discussed, that for capital gains, the definition of transfer under section 247 has not been amended. Similarly, for stock in trade, there is no amendment or there is no provision in section 28 regarding the taxability of this amount. And probably, since the amendment has not been made in these sections, therefore probably a special section 9b has been prescribed. But again, this may be a legal issue which may be raised at any stage, but I don't think that there is any rescue, or one can say that the taxability can be challenged on the ground that there is no amendment under section 28 for that matter. Another question may come: how to calculate fair market value? Fair market value in the case of capital asset and fair market value in the case of stock in trade. So far as the asset is concerned, section 222b is in the statute where it has been prescribed how the fair market value of the asset has to be arrived. The asset, if sold in the open market, whatever the price it can fetch is the fair market value. which is prescribed in section 222B. But for the stock in trade, no such definition has been given under the Act. But if we have to take the fair market value of the stock, probably the same definition will have to be borrowed for the purpose of arriving fair market value of stock in trade as well, in my opinion. Dr. Rakesh on this issue.
Yes, yes. So fair market value in common parlance means the price which a stock in trade item would fetch if sold in the open market in uncontrolled conditions. So this is the fair market value. But then one thing which is an aspect which has come into my mind is, so far as the computation of capital gain under that capital gain for section 9B is concerned, then it has to be computed under that income from capital gain, because it has been so prescribed. But this income, though under the head business, but what about the disalliances which are there, such as 40A3? Suppose a stock has been purchased in cash in violation of section 40A3. Now, whether while computing the income under that business, such kind of disalliance can be made or not, because there is no amendment in section 28, and section 29 says that while computing the income under section 28, the provisions up to section 43D will have to be taken into account. So the question comes, since there is no income under section 28, since there is no amendment in section 28, though fiction has been that it will be treated as income under that business, but then what about the disalliances which are there under that business? But all said and done, according to me, even if there is no amendment in section 28, but the fact of the matter that it is getting taxed under that business, therefore even 40A3, if at all it is applicable in the facts, on the ground that the stock has been purchased in cash, that will apply, that should apply.
Next, yes, one more question comes, that when a partner, in case of reconstitution, gets an asset or a stock, then what would be the cost of acquisition in the hands of the partner receiving such asset? By common by common sense or by reasonable interpretation, it is the fair market value at which firm is being taxed. That should be the cost of acquisition in the hands of the partner. Whenever the partner will sell this asset at any later stage, then the cost of acquisition to the partner should be the fair market value of the asset at which firm has paid the taxes. But section 49 regarding the cost of acquisition has not been amended for this purpose. But I can just point out that the circular which has been issued by CBDT and the guidelines which have been prescribed with respect to these sections, this is the circular dated 2nd July 2021. There, at one of the examples, they have stated clearly that the cost of acquisition in the hands of the partner shall be the fair market value at which firm has been taxed. Any comments, Dr. Rakesh?
Yes, very right. There is no amendment in section 49, but that circular which has been issued on the strength of section 9B subsection 4 and subsection 5 in order to relax the rigor. So board has, by way of one example, has explained it like this.
Next, another question may comes that what should be the accounting treatment in the books of accounts for the situation which is being created by this section 9B. In fact, section 9B prescribes that asset is a deemed transfer. It is to be presumed as a deemed transfer. So the proper accounting treatment should be that the asset may be treated as transferred to the partner at fair market value, and accounting entry may be passed in the books of accounts. Taxes which are required to be paid and the gain which has been which has arisen in this transaction, that has to be credited, or the taxes to be paid have to be netted by that amount, this has to be credited to the all the partners' capital account, including the outgoing partner, because it is the share of all the partners where the asset, it is the share of all the partners in the gain or in the profits of the asset which is being transferred now to a particular partner. Board in its circular has given two examples, example 1 and example 2. In one example, they have demonstrated that asset is given to the partner at fair market value. And in second example, they have demonstrated that asset is sold in the open market at fair market value. The result in both the cases is the same. And they have clearly stated, which is quite rightly they have stated, and which is logical also, that any gain net of taxes is required to be credited to the partner's capital account, including the outgoing partner or including the partner who is receiving this particular asset. This credit is very important from the point of view that by this amount, the amount credit in the capital account of the partner shall get increased, and by this increase, the applicability of section 45(4), where an amount is paid to the partner in addition to the credit in the capital account is paid, that will get impacted or that will be reduced to that extent. So therefore, this is very clear that in case of partnership, in case of applicability of section 9b, the accounting entry in the books should be passed as if the asset has been transferred to the partner on fair market value. So debiting the full value to the partner and crediting the gain to his share, to the extent of his share to his account, and to the extent of the share of the existing partners to their account. This will make the things
So, so,
quite
so, so,
simple,
so,
clear,
so,
and logical.
so the message is loud and clear. When there is attraction of section 9b and section 45 for both, then in that situation 9b will have to be applied first, and then accounting entry accordingly is required to be passed in the books of account, so that the partner's capital, I mean, gets credited with the amount of profit on the deemed transfer, so that while computing capital gain under section 45(4), that increased amount of the outgoing partner's capital, now that gets reduced.
So now let us move to section 45(4). And before I start analyzing section 45(4), let me again reiterate, because there are a lot of concern in the minds of the professionals, or in the minds of the professional in the professional circle, that to what extent the taxation of partnership firms or the partners is getting affected or getting impacted by these provisions. So far we have seen that section 9b is applicable only when asset or stock in trade in kind is given to the outgoing partner. If no stock or stock in trade is given to the outgoing partner, I am using the word outgoing partner, but it means that specified entity, and that may be any person in the case of reconstitution. But loosely, I am using the word outgoing partner, because in most of the cases in this situation, the applicability of this section is applied. So it is applicable only when asset in kind is given. If no asset in kind is given, there is no applicability of section 9b. And applicability is only to the extent that it is deemed, it is as a transfer by the firm, and sale consideration in the hands of the firm will be taken to be the fair market value of the asset. So I mean, that is a very straightforward provision which is there in section 9b. Now we
So
come to
this
section
is a very
45.
this is a very nice summing up, that 9b, unless the partner receives any capital asset or stock in trade, there is no taxability under section 9b, because many times we all tend to believe the moment there is a dissolution or reconstitution, as if the liability of capital gains or liability of tax is staring at our face. It's not like this. That's very nicely summed up by
Yes.
Raj
So
sir.
this is the implication of 9b. And when now we are talking of section 45(4), I may just add here simultaneously that section 45(4) is applicable only when, only and only when the amount paid to the partner or to the specified entity or to the outgoing partner is in excess of the amount lying in the credit of his capital account. If you are paying to the partner only the amount which is lying in his capital account, then there is no applicability of section 45(4). So 45(4) is attracted only when the payment being made to the partner, and payment may include the, if asset is being given in kind, then fair market value of the asset, and any monetary amount if it is being given. So when a partner is being given the amount in the case of reconstitution, he may be given in kind or in cash. So in kind, if it is being given, then the value, fair market value of the asset will be taken, and if monetary amount is also given, then the cumulative amount of the fair market value asset and the monetary consideration. If that amount, both of these amounts cumulatively are in excess of the amount lying in his credit in his capital account, I will discuss what does it mean credit in the capital account. But if that is in excess of that, only then taxability under section 45(4) is attracted. Otherwise, there is no taxability under section 45(4) to the partnership firm. Because I have seen in my professional practice, in most of the cases, it is not that excess amount more than capital account is given. It is only the amount which is lying in the capital account of the partner which is given. If that is only being given, no taxability, either in the case of retiring partner or reconstitution of the firm, in both the cases. But if in both the cases any amount in excess of the amount lying in his credit of his capital account is being given, only then there is applicability of section 45(4). In the case of dissolution of firm, 45(4) will not be applicable, because when all the assets will be sold or all assets will be given to the partners, then all amounts which are, all the profit and gains which has arisen will be credited to their capital account. If no other asset is existing, then there cannot be that any amount in excess of his capital account can be paid. All assets are liquidated, capital account is credited, liabilities are settled. In case of dissolution, when all accounts are settled, all assets are either liquidated or given to the partners. If given to the partners, section 9b would be applicable. The gain would be credited to their capital account. So there cannot be a situation when the balance in capital account in case of dissolution of the firm can be more than the amount lying in their capital account. Therefore, in the case of dissolution, there cannot be any applicability of section 45(4).
And therefore, the legislature has not so provided also.
Yes,
That is
not
the
provided
rationale.
also.
That
I
is
will
the
just discuss the rationale, that what is
Yes.
the rationale. But prior to that, let me just discuss that to whom section 45(4) gets applicable. Next, Somil. First of all, let us just give a thought that as per section 45(4), Somil, prior to this, let me discuss the rationale. Next slide. Let me just discuss the rationale of section 45(4). Then I will discuss the earlier slide. What is the rationale of section 45(4)? In fact, when section 45(4) provides that the amount paid to the partner in excess of the amount lying in his capital account, it is going to be taxable. It means that we have just seen that whatever the profits earned by the partnership firm in the lifetime or during the course of business, those all are credited to the capital account of the partners. So what may not be credited to the capital account of partners, which may be required to be paid to the partners, it can be the unrealized gain or unrealized appreciation in the value of the existing assets. The assets of the firm which are existing, which are not being given to all the partners, because in case of dissolution all are given, then everything is taxed and credited to the partners. But in case a partner of 25% is going, 75% of partners are already retaining and they are running the partnership firm. Then if we are paying in excess of the amount lying to his credit, then whatever the internal accruals or profits or gains of the business have occurred in the normal course of business, those have already been accounted for by way of credit to his capital account. What is not credited to his capital account is the unrealized gain of the existing assets or the assets which are self-generated assets. Self-generated assets may be brand value, goodwill, patent, copyrights which have been developed in the course of life of the firm, but these assets are not captured or are not, there is no cost of acquisition, these are self generated, cost of acquisition is nil, these are not captured in the books of accounts. Or the assets, maybe some land you purchased for 10 lakh rupees, but today the value is 10 crore rupees. Appreciation, unless you have revalued in the books of accounts, it is not captured in the books. But the fair market value is 10 crore now. You have purchased only for 10 lakh rupees. When any partner is going, he is entitled to get his share in this appreciation. And that is how the excess amount is required to be paid in excess of the capital account to the partner. And that is the rationale that if any excess amount is being paid, that amount represents the appreciation in the revaluation of the existing assets or the valuation of the assets which are not captured in the books of accounts, which are self-generated assets, maybe some intangible assets, maybe goodwill of the firm. That share is given to the partner, and that share is being now taxed in the hands of the firm. It has been provided by the legislation that that amount would be taxed in the hands of the firm. Logically speaking, to my mind, it should have been taxed in the hands of the partner who is receiving this excess amount. I tried to understand, to ponder upon that what can be the rationale, that why it is being taxed in the hands of the firm, not in the hands of the partner who is receiving. Otherwise, in normal scheme of the Income Tax Act, a person who receives any profit or gain, or who receives any amount, or who has earned the profits, he is liable to be taxed. But instead of the outgoing partner, you are taxing to the firm. This I could not understand. Maybe if some light Dr. Rakesh Gupta may like to throw on this, he may also throw. But prior to that, I tried to compare it with DDT also, or with erstwhile Section 45 or for also. In dividend distribution tax, the situation is it was also being taxed in the case of the company, not in the hands of the shareholders earlier. Now the position is reversed. Now it is taxed in the hands of the shareholders. But when dividend distribution tax was there, it was being taxed in the hands of the companies, not in the hands of the shareholders. The similar is the situation here. When you are giving something to a partner, instead of taxing to the person who is receiving, you are taxing to the partnership firm. So, but in the case of DDT, it was being paid to all the partners across. So, whatever the reserves and surpluses, those were the amount to be enjoyed, or those were the profits representative of all the partners or all the shareholders. And out of that, if dividend is being given, then it is dividend distribution taxes also being paid by the company. It was equal to all the persons, all the shareholders. So there was a logic to this. But in here, what is the point which does not seem to be logical to me, that you are the tax which a partner who is receiving the amount in excess of his capital account, it is his gain and he is liable to pay the taxes. That taxes are being charged to the firm and indirectly to the existing partners. If it is charged to the firm,
Very right,
it
very
means
right.
you are charging from the existing partners. Now there is no commercial sense. How a person, when you will, I give a very simple example. For example, there are three partners in a firm, and one third, and there are total assets of say 300. Capital account is 300. And the revalued figure of the assets is 600. Now, if revalued figure is 600, one third partner is going, simply that 200 is to be given to him. You will give 200 to him. In excess of 100 is lying in this capital account, 100 will extra will be paid. On 100, for example, 30% tax is attracted. And now this 30 rupees tax will be charged to the firm. To the existing partners will have the kitty of 400 minus 30, 370, and the outgoing partner will get 200, which is not commercial sense. It does not make commercial sense.
Very right.
So the proper commercial, because if law is like this, then what would happen? Either the tax which is being paid of the share of the outgoing partner will be recovered from that partner. If it is recovered from that partner, then it may, or while calculating his share to be paid in the commercial parlance, as per the commercial formula, that how the amount is to be arrived, it will have to be decided or to be calculated, giving effect to the tax which would be applicable on this amount. Only then there can be parity between all the partners and proper distribution of the assets equally in the ratio of the partnership. So I mean, the logic or the rationale of taxing this amount in the hands of the firm, I could not understand. Rather, I will say that if this would have been taxed in the hands of the partner, the legislation rather wanted to give extra advantage of paying this tax at the time when the existing assets which have been partially revalued now and given to the partner are sold at a later stage, then the attribution of this excess amount paid would be there, which we will discuss in the later part of the applicability of section 44.5.4. Probably from that point of view, the legislature has prescribed it under section 45.4 that it will be taxed in the hand of the firm. But even without this, they could have provided the provision in such a manner that taxability would be in the hands of the partner receiving the asset, but the amount which is being paid to the partner could have been attributed to the existing asset as well in that situation also. And nonetheless, I am not going regarding the wisdom of the legislature. I am just trying to explain that what is the legislation, what is the law, and how it is to be implemented. Unless certain amendment is made at a later stage. Dr. Rakesh Gupta, any comment yours?
No, you're right. I mean, on the first blush, the tax incidence in case a partner receives more than his capital ought to be on him. Rather, a portion of it is being borne by the existing partners.
So now the previous slide. Yes. Now let us understand that what is the provision of section 45.4 and how it is getting operated or implemented. But whenever we are discussing 45.4, we should always keep in mind it is only the excess amount in addition to the capital which is lying in the credit of the partner. If it is paid, only then there is a taxation of section 45.4. And that amount is going to be taxed in the hands of the firm as capital gains. Now again, this may be a contentious issue. They have provided this will be taxed because it is in the chapter of capital gains for section 45. They have provided, so they are saying it will be taxed as a capital gains in the hands of the firm. Now in the hands of the firm, if it is going to be taxed as capital gains, whether this would be a long-term capital gain or short-term capital gain, it comes to the first question. For that, Rule 8AA5 has prescribed that if, first of all, prior to this, let me just tell that if any excess amount has been paid, what does this excess amount represent? Just I said that this excess amount represent the revaluation of the existing asset to the extent of the share of the outgoing partner. So it is a partial revaluation of the existing assets or valuation of the assets which are not already, which are self-generated asset, and the amount which is being paid access to the partner represents the share of the outgoing partner in the existing, in the revaluation of the existing asset or the valuation of the self-generated asset. So this is what the this is what the nature of this amount is there, and since it is being taxed in the hands of the firm, therefore legislation has provided that the benefit of cost of such amount on which tax has been paid by the by the firm shall be given at any later stage when such assets are sold. And therefore the amendment under section 48 clause 3 has been made, a new clause has been inserted providing that in the case when any capital asset is sold, then any amount which has been paid earlier to the partner on which access on which tax has been paid by the firm, it will be attributed to the assets, existing assets or self-generated assets. This attribution, for the purpose of this attribution, Rule 8A-B has been prescribed. But prior to this, first of all, so far as Rule 8B is concerned, the attribution has to be made on the basis of revaluation of the asset. Revaluation means existing assets will be revalued, and if any self-generated asset is there, then that will also be revalued, and the amount which has been paid to the partner would be on pro rata basis shall be allocated to these assets to the extent of his share. And if excess amount paid is in excess of the revalued figure of the assets, that will be ignored. It is not necessary that whenever a partner is given, exactly the terms which are decided between the partners are to the extent that it represents the revaluation of the assets only. There can be several other considerations due to which some excess amount may be paid to the outgoing partner. Maybe his nuisance value, I say, one of the thing. Maybe that that person was having some extraordinary talent or extraordinary contribution for which amount is given, but asset it is not represented, or because revaluation of the asset has to be done by the registered valuer. It is not that the whole of the excess amount can be attributed to all the assets. First of all existing assets will be required to be revalued on those on pro rata basis. There would be attribution, and if there is any self-generated asset, so the balancing amount, self-generated assets may be goodwill, patent, copyright, brand value, you can attribute to that, but that is also required to be done on the basis of valuation of by the authorized valuer, or there can be valuation of goodwill also. In most of the cases, excess amount is paid which represents goodwill of the firm, which is not self-generated, which is not captured in the books of account, which is has cost of acquisition nil, which is self-generated. So it may be attributed to goodwill also. But in section or in rules, it has been provided that revaluation has to be required to be done by the registered valuer, either of the existing assets or of the self-generated assets or of the goodwill. And if any amount, even after revaluation by the authorized valuer, though in my mind, in my opinion, in revaluation, goodwill should take care of all the balancing amount, because whatever is being paid represents goodwill. But even if goodwill is also not taking care of the amount, excess amount which has been paid, then in that situation, that amount will be ignored. That amount will not be allocated or attributed to any of the assets.
Yeah, Rajkumar,
Yes.
I think you should explain it with an example. But then prior to that, now in case of reconstitution, if any money or capital asset is given to the partner in excess of his bare capital, then that will constitute capital gain. So the
Yes.
formula which has been given in the section is A is equal to B plus C minus D. B refers to money given. C refers to the fair market value capital asset, and minus D. D means the capital account without any effect of revaluation at any point of time. So if
Yes.
money has been given, say 40 rupees, fair market value of asset which has been given on reconstitution is 60 rupees, 100 rupees, and capital balance is rupees, say 60 rupees. So 40 rupees has been paid to him Axis, and that 40 rupees would constitute capital gain in the hands of the firm. Is this understanding correct?
Yes,
Number one?
yes.
Now this
Yes.
40 rupees on which this firm will have to pay tax. Now rule 8AB says under section 48(3) that this 40 rupees will be apportioned or will be given advantage to you. 40 rupees reduction will be given to you means to the firm, when firm sells its existing assets at later stage. So that is what rule 8AB says.
Yes. So this 40 rupees has to be attributed to the existing assets or self-generated assets on the basis of the revaluation done by the authorized valuer.
So this 40 rupees will have to be attributed to the existing assets in the ratio of revaluations done by the registered valuer as on date.
Yes.
Okay. So this 40 rupees credit this firm will get, though it is paying tax today, would get its credit when it happens to sell its existing asset in future.
Yes.
This is rule
Yes.
8AB
And
says.
another related point is this would be a short-term capital gain or long-term capital gain. Now we will have to see which, because rule 8AA5 is prescribing it. If the asset on which this excess amount is being attributed is long-term capital asset, then it would be a long-term capital gain. Otherwise, in all other cases, either in the case when asset is a short-term capital asset, or it is a self-generated asset, or it is a goodwill, in all these three cases, it is going to be short-term capital gain. So the taxability in the hands of the firm as long-term capital gain or short-term capital gain has to be decided by the fact that how much amount is being attributed to which asset on revaluation.
So this 40 rupees capital gain is to be calculated without any indexation, cannot be calculated with indexation because
Yes.
a partner may be paid money only. So there is no concept of indexation, that we must be clear.
Yes.
Now the example which I gave, 40 rupees is the capital gain on which the firm will have to pay tax. The character of this 40 rupees, whether it is a short term or long term, would determine with reference to the existing assets on which this 40 rupees will be attributed. Is it correct?
Yes, exactly.
So if it is attributed to, say, long-term capital asset, then that portion will be long-term capital gain, and that portion of 40 rupees which is attributed to short-term capital asset or depreciable assets, then that will be short-term capital gain on which 30% tax would be levied.
Yes, exactly. This is the provision. And another thing they have provided, that no depreciation on such amount attributed to the assets. If the amount is attributed to the depreciable assets of the block of assets, then depreciation will not be allowed. The rationale of making this provision is, to my opinion, is that this excess amount represents partial revaluation of the assets. It is the appreciation in the value of the assets as revalued to the extent of share of the outgoing partner which is being paid. And on revaluation, depreciation is not allowed. Depreciation is allowed only on historical cost. So therefore, they have provided, and they have not made any amendment in section 32 that they have specifically stated that depreciation will not be allowed on the amount attributed to the assets. But as per section 48(3), it has been 48 Roman clause 3. It has been provided that such amount would be allowed as deduction at any later stage when such asset is sold or transferred by the firm.
So if I simplify it further, suppose in that example, this 40 rupees capital gain, now firm will have to pay tax, and there is only one existing asset, एक लैंड है फर्म के पास और So when we say that 40 rupees will have to be attributed to the remaining asset, so that remaining asset, that is land, suppose is sold later on for rupees 200 by the firm, तो उस 200 में से 40 रुपीस का रिडक्शन और मिल जाएगा कॉस्ट के अलावा.
Yes.
हैं?
Yes.
ये इसको इस तरह से हम सिंप्लीफाई करके
Yes.
समझे.
200 में से 40 लेस कर लेंगे 160, और 160 में से जो भी कॉस्ट ऑफ एक्विजिशन उस एसेट की होगी उसकी इंडेक्सिंग हो जाएगी. इस 40 रुपए की इंडेक्सिंग नहीं होगी, उसकी 160 की इंडेक्सिंग करके, क्योंकि इसको कॉस्ट ऑफ एक्विजिशन नहीं माना गया है 40 रुपए को, तो उसकी 16 जो भी कॉस्ट ऑफ एक्विजिशन की इंडेक्सिंग करके लेस करके जो भी अमाउंट होगा उस पर कैपिटल गेन टैक्स लगेगा.
तो इसका मतलब ये हुआ कि इस एग्जांपल में जो 40 रुपीस पर पार्टनरशिप फर्म हैज पेड टैक्स, इसका क्रेडिट जब भी मिलेगा व्हेन दैट फर्म हैपेंस टू सेल इट्स एग्जिस्टिंग एसेट at some point of time in future, and if
Yes.
firm
or
does
in
not,
case of dissolution, or in case of dissolution of the firm.
no, I'm talking in case the firm does not sell its existing asset at later stage, तो 40 वाला जो टैक्स दे दिया है वो दे दिया, that credit will not be allowed.
Yes,
ये है ना.
yes, exactly. So next, accounting treatment. Amount paid to the outgoing partner to be attributed to the existing assets, self-generated assets, as per Rule 8AA. I have broadly explained Rule 8AB as well. And this
कितना टाइम हो रहा है
commercial,
क्योंकि फिर क्वेश्चंस लेने पड़ेंगे फिर हमको.
अभी लेते हैं ये इसका कॉमर्शियल जो एस्पेक्ट है वो भी मैंने डिस्कस कर लिया है. अब एक पॉइंट ये आता है कि ये जो एक्सेस अमाउंट हम पे कर रहे हैं इसका अकाउंटिंग ट्रीटमेंट क्या होना चाहिए. मैंने इसमें 3 बातें लिखी हैं कि देयर कैन बी 3 ट्रीटमेंट. वन इज, जनरली हमने पहले जो पढ़ा है वही होता है कि अगर किसी पार्टनर को, आउटगोइंग पार्टनर को एक्सेस अमाउंट देते हैं, it is debited to the capital account of the existing partners. Either they bring, or some incoming partner is coming, he brings his capital, and excess amount paid is debited to the existing partners. So one accounting treatment can be this excess amount paid is debited to the existing partners, because the rationale is because their share in the existing assets gets increased. Earlier, they were partner in the existing assets to the extent of 1/3. Now they are partner to the extent of 50%. Therefore, whatever the excess amount has been given, the appreciation in the value of the assets, which is not captured in the books of accounts, that has been paid. And since now their share in those assets and in those appreciation of those assets has got increased, therefore it should be debited to their capital account. This can be one treatment. But if we debit to the capital account of the partners, then attribution and later on claiming at any stage after 5 years or 8 years in the case of firm when that asset is sold would be a practical problem. It may not be possible. So the second treatment can be that we add to the value of the existing assets whatever amount has been attributed. We can add to those assets value itself. But here also, if we add to the value of the assets, then if it is depreciable assets, then we will have to keep separate account, because on this amount depreciation is not allowable. Or in the case of other assets, it represents partial revaluation of the assets. Then whether any disclosure from the point of the accounting standards is required to be made or not, that can be another issue. So third treatment, which I think can be a better treatment, that this amount may be kept in a separate account as an asset pending allocation.
40 rupees.
Allocation formula, allocation amount may be decided at this point only, because at every stage, whenever this exercise is to be done, when any excess amount is being paid and section 45(4) is attracted, all assets are required to be revalued. Amount is required to be allocated to the existing assets. It would be freeze today only. But instead of adding to the value of the existing assets, we may keep it in a separate account as asset pending allocation. And whenever any such asset is sold, then the amount may be transferred from this account to the asset which is being sold and may be claimed as a deduction under the Income Tax Act. So this is, I mean, suggestive, but these can be three different treatments. And to my mind, keeping in view the practicality and convenience and the principles of the accounting standards, which may be also attracted, I feel that the third accounting treatment may be a better treatment. But still, I mean, there can be this may be a contentious issue. There may be a discussion amongst the accounting fraternity so far as the treatment is to be made to the books of accounts. Yes, Dr. Rakesh.
Yes. Now, Rajkumar, there are several questions which have come. Now, in the
Okay.
meantime, you discuss the question which has been sent. Very nice question by Mr. Rahul Kant. But in the
Okay.
meantime, I would request Somil, I have just WhatsApped you the questions which have been sent by Sri K.K. Singla ji. So, after exhausting the question of Sri Rahul Kant, Sri K.K. Singla, then we will take other questions.
Yes. Let me discuss Mr. Rahul Kant's issue. Somil, is it the same issue which you have sent by on WhatsApp?
Yes, yes,
Yes.
yes.
Yes, yes. So this is a very good question, and Rahul ji is a very dear friend. And Rahul ji, so far as
No, first
attraction
of
of
all,
section.
first of all, you tell what is the question so that everybody else can understand.
Okay, okay. Somil, would you please read the question?
There's very
Yes.
lengthy question. Now, let us summarize it.
Yes.
It is a real estate developer's case. It's a partnership firm in which the land is the inventory. Land is not capital asset. So, but then land is land. Land appreciates. That appreciated values share of the partner is given to partner, right? And then the question comes that this excess amount paid to one partner because of such kind of appreciation in the value of land, now can that be attributed to the existing land by the firm?
So the precisely the question is that if this excess amount is being paid, and that is due to revaluation of, it can be due to revaluation of the capital asset, or assets which are not existing, which are self-generated asset. And apart from that, there can be a third situation where it can be due to appreciation in the value of the inventory. And particularly in the case of real estate developers or real estate owners, inventory is of real estate, of land, and there is huge appreciation. There may be huge appreciation in the value of land. So in the section 45.4, there is no prescription regarding attributing this excess amount to the value of the stock in trade or to the value of the inventory after revaluing it. It is not there. Rather, they have prescribed that if there is no attribution to the capital asset or to the self-generated asset, then that excess amount shall be ignored. But now, what my submission is that in section 9b, subsection 4, there is a provision that in case any difficulty is found in implementing these provisions of section 45.4 and 9b, then CBDT may issue the guidelines. CBDT has issued the guidelines, which I have referred earlier also, where certain examples have been given and these provisions have been explained as on 2nd July 2021. And there they have said that the attribution to capital asset and allowing of deduction under section 48 Roman 3 has been prescribed, which can be attracted or which can be applicable only when asset is a capital asset. If it is a depreciable asset, if it is a asset forming part of block of assets, then it is not taxed under section 48. It is taxed under section 50. Or for that purpose, section 43 is the cost of
Six
acquisition, how it is to be
WDV.
arrived at. So therefore, whether for depreciable asset, no attribution in the revaluation can be done. There they have given in the guidelines that though it is not provided in the section, but for the purpose of removing the difficulty, we are prescribing as per the powers drawn by subsection 4 of section 9b that such excess amount can be attributed to the revalued depreciable asset also. But now I stop here. Now they have provided for the depreciable asset, which was not in the section, but not for the inventory. Now there can be two interpretation of this. Either they should have provided for inventory also. If they have specifically not provided for inventory, then in the case of inventory, if it is revalued, then no amount will be attributed. It can be one interpretation. Or second interpretation can be that inventory revaluation has also been missed in the provision as well as in the guidelines, when one can draw the parallel and the logic from the attribution which is being made to the depreciable assets and other assets, and on inventory, and particularly in the case of real estate, when there is a huge appreciation in the value of the inventory, that can also be applicable to that. So it is a matter of litigation and making out a case that both ways, the logic can be drawn, and one can argue. But to my mind, logically, it should be allowed. Or alternatively, another way can be that we capture this appreciation instead of revaluation in the value of the inventory as goodwill, because this appreciation represents the goodwill of the firm in some or what manner. But by doing it at the time of selling of the inventory item, to transfer the amount of the goodwill attributing to the item of inventory may not be possible, and that will not be allowable probably. So therefore, that treatment, I will say, should be ruled out. Rather, one should try to make out a case drawing a parallel that if depreciable asset and other assets are covered to be attributed by the excess amount being paid or which is being taxed under section 45(4), then for the purpose of inventory items, if there is a huge appreciation in the inventory items, then also some attribution should be permitted and should be allowed. This is my take on
Rahul Khan's question was that if the partnership firm was having only land as inventory and a partner has been paid excess, then his capital account, then whatever capital gain comes to the firm under section 45(4), now whether that capital gain will be attributed to the remaining land which is held as inventory or not. So legislature has provided the attribution of the capital gain of 45(4) only on the remaining capital assets, not on inventory assets. So if we read literally section 48(3), rule 8AB, then that capital gain of 45(4) which this firm has paid now will not be attributed to the remaining inventory of land. But as Raji has said, that since guidelines are issued to relax the rigor of section 9B and 45(4), and therefore when guidelines have relaxed the rigor by providing that not only capital assets but even those assets which are depreciable, though they are also called capital assets, though they are depreciable, their method of calculation is different. Section 48(3), from which rule 8AB is generated, does not talk of depreciable asset, but that guidelines board circular has provided attribution on such depreciable asset. So Dr. Raj's contention is that there may be some clarifications in the form of that circular, that even in respect of inventory, because land is something which may be held as an inventory, but then really something which gets appreciated. Therefore, on a parity, on the reasoning of parity, such a land inventory should also be overloaded with this capital gain. That is what I have understood.
Yes, exactly.
Right. Okay.
Yes.
Now, Somil, Mr. K.K. Singla, the president of Patiala Tax Bar Association, has sent several questions. Maybe few of them may have already stand answered, but then you can ask by reading the question.
Yes, sir. So the first question is whether any capital gain tax liability will arise in firm undergoing change in constitution, wherein some of the partners retire and some new partners are introduced without any revaluation of its immovable assets. The retiring partners are paid only the capital standing to their credit. Land is in the name of the firm.
Okay. So
So,
as Raji has said in the beginning, that if retiring partners are paid only capital standing to their credit minus any amount which was referable to revaluation, then there is no capital gain under section 45(4), because B plus C minus D. B is money, C is the value of capital asset which is given to the partner, minus D means the capital. And if there is some amount of revaluation which is credited to the capital account, that capital account will have to be reduced by that amount. So if capital account equivalent is paid to the retiring partner and capital account is the bare capital account, then there is no capital gain under section 45(4). Raj sir, is it correct?
yes, yes, exactly. Because
Okay.
we should the bottom line of applicability of these provisions should always be kept in mind.
Yes.
Section 9B is applicable only when a certain kind is given. If no certain kind is given, there is no applicability of section 9B. And section 45(4) is applicable only when amount paid to the partner is in excess of the amount credited to his capital account. If the amount is being paid to the extent of the amount credited to his capital account, then there is no applicability of section 45(4), in spite of any kind of reconstitution of the firm, whether any partner is joining, whether the share of the existing partners is being reduced, whether it is being readjusted or some partner is going. Generally in professional firms, it keeps on happening. We keeps on partners keeps on coming, partners keeps on going. Their share profit loss sharing ratio keeps on changing. In any of the situation, if the amount being paid to the partner who is leaving or to the partner whose share is being readjusted or being reduced, if it is not in excess of the capital account being credited to his capital account, if it is not in excess of that, then there is no applicability of section 45(4).
Yes.
Here,
Next
here,
question.
before I mean, I can add one point. If Rakesh, we can discuss related point on this issue. Whether in such a situation, section 56(2)(10) of the income tax can be attracted, because if the share of the partner is being reduced and some other partner is getting his share, it means some benefit has been transferred by a partner to the other partner. In such a situation, whether the value of that the value of the
That
partnership
increased. Increased.
the value of the share in the partnership firm, can it be valued, and whether it can be taxed in the hands of the partner who is getting the extra benefit or extra share in the partnership firm without consideration. To my mind, section 56(2)(10) will not be applicable, because it is applicable to particular assets, and in the definition of asset, it is not applicable. The asset definition does not include the share, the rights in the share of partnership firm, or right in the partnership firm as a partner. That is not a asset. It is a it can be said to be an intangible asset, but that is not included in section 56(2). And there are number of Supreme Court judgments earlier, the law which used to be pleaded earlier, that in case of readjustment in the ratio of the partners, it is the readjustment of the rights and obligations of the partners, and it does not amount to attraction of any capital gains or tax liability. So the same principles. And moreover, section 56(2)(10) does not include the right in the share in the partnership firm to be a capital asset to be covered under section 56(2). Therefore, this will also not be such adjustment or readjustment will not be covered by this section also. So therefore,
Okay.
I will
Next.
say that in case there is any readjustment in the ratio of the partners without paying any amount in excess of the capital account balance of the partner, no rigor, no attraction of section 45(4). Yes, Rakesh.
Somil, next question, because we are racing against time.
Yes. Sir, it is in continuation of the first one itself that if the incoming partner pays any lump sum amount to the retiring partners from their personal account, will there be any capital gain tax liability in the hands of the partnership firm or the retiring partner?
It's a very good question. Now, if the incoming partners and outgoing partners, they deal between themselves. Now, whether there will be 9B or 45(4). So the response to this is that in the age of GAR, now the question would come, why incoming partner has paid to the outgoing partner? So if it is absolutely not in connection with the reconstitution of the firm and the department is not able to establish, then this is the transactions between incoming and outgoing partners. Then the question would come between them that why the amount has been paid by incoming partner A to outgoing partner B. Then the response may come, ये disturbance क्या रही है? The response may come that A has paid to B for acquiring the interest in the partnership firm. So whether that interest in the partnership firm can constitute a capital asset in itself, and whether the transfer by B to A, his interest in partnership firm, ये रकम पेपरों से आ रही है शायद, will give rise to capital gain. So yes, interest in the partnership firm definitely would be a capital asset. Then in that situation, there may be implications of the capital gains. But then if the firm is involved, then of course 9B or 45(4), then that will come. Yes, Rajkumar, कोई इसमें कोई point?
हाँ, मतलब this can again be a contentious issue. If any amount is paid by partner to the other partner for acquiring the rights in the partnership firm outside the firm, first of all, there cannot be any taxability on the firm in such a situation. If amount has been paid outside the firm by one partner to the other partner. But as Rakesh ji has said, that interest in partnership firm is an intangible asset, or it is in the form of a capital asset. Therefore, it may be taxable as per the normal provisions of Section 45(1) of the Income Tax Act. And in such a situation, how the value of cost of acquiring the asset has to be determined, that may be a contentious issue. That if consideration has been received for relinquishing 10% of the rights, then what is the cost of acquisition of 10% of the rights? And if computing machinery fails, then in such a situation it can be said that it may not be taxable. And there can be many facets so far as this aspect is concerned. But nonetheless, it is a contentious issue, and there can be a lot of litigation on this issue.
Somil, next.
Yes, sir. Is revaluation of immovable assets compulsory in case of reconstitution, where the retiring partners are paid only the capital standing to their credit? Land is in the name of the firm.
So revaluation of immovable property, I mean, is not necessary. And if the retiring partners are paid only whatever is credit to their capital account, then there is no attraction of capital gain under Section 45(4). Even at the cost of repetition, we would say. Kyun, Saksham?
Yes, sir, completely.
Yes. Okay. Next question, Somil.
Yes. If two persons buy, and it is a little long one, if two persons buy land in their personal names and constitute a partnership firm, and the building is constructed by a firm by raising loan and self contribution, land continues to be owned by the partners in their individual names and does not form part of business assets of the firm. After some time, one of the partners retire and another person is introduced as partner. Please advise, in the event the retiring partner after the date of retirement transfers to the firm the land held by him in his individual capacity, whether capital gain accrues in the hands of retiring partner in his individual capacity or the capital gain tax liability have to be borne by the firm.
When retiring partner is transferring his individually acquired asset, which is his individual assets, to the partnership firm, then that partner in his individual capacity is selling or transferring land to the partnership firm. Then, subject to section 50C, I mean the capital gains tax liability will come in his individual hands. Yes, next. So Rajiv, इसमें तो कोई नहीं
Yes,
add
yes,
करना? Okay.
yes, yes.
Yes.
Carry on.
Yes. A firm has two partners, Mr. A with 75% share and B with 25% share. There is reconstitution as on 1st April 2023. And a new partner C on induction gets 5% share out of 25% of B, who is father of C. No capital is introduced by C. What will be the impact of 9B and 45(4) separately? The firm owns land and building as well as there is stock in trade.
So, as we had been saying right from the word go in this webinar, that unless the partner receives any capital asset or stock in trade, there is no application of section 9B. Unless partner receives any capital asset or money in case of reconstitution in excess of his capital, there is no capital gains under section 45(4). Okay, so in this example or in this question, since partner is not receiving anything, so there is no question of 9B or 45. Yes, next.
Yes. Can we execute this single deed? I understand the partnership deed when some of the partners retire and some new partners are inducted.
Yes, yes. But then you will have to show the induction a moment earlier than the.
This is a question of civil law, and I think this may be allowed. There is no.
Yes, this is allowed. This is
no bar on
allowed.
this.
Yes, yes. Now, Saksham, are there any questions?
Yes, sir, there are questions. People have
Okay,
raised
so
some important questions.
kindly on it so that it's already 1:30.
Sure, sir.
1.5 hours.
Saksham, you have them or should I show them on the screen?
So please show the questions. I don't have the access for that.
Yes. The first question that we have is,
Sir, Mittal Sahab ka hai. Immovable property has to be transferred by way of sale deed. How the sale can be executed without mentioning the payment by way of check or bank transfer in excess of rupees 20,000? No, we could not get this question.
This is not relevant. Next.
Next, please. Rakesh Kazla, sir, in case rural agricultural land is stock in trade. Very good question. Now, Kazla Sahab, if you remember, you forget 9B and 45(4). This question, whether the rural agricultural land, if it's stock in trade, now if it is sold by the trader, whether the gain or the profit resulting from the sale of that inventory of rural agricultural land, whether if at all would be exempt under section 21A, that is a question. That is a question that rural agricultural land, if it is an inventory, if it is sold by the trader, the profit, whether would still be the character of agricultural income under section 21A, that is a very contentious issue. Department says no, it has acquired the character of business income, but then the SSE says irrespective of the nature of the rural agricultural land, whether it is inventory or capital asset, its sale or profit would result into the agricultural income under section 2 subsection 1 capital A. So that is a $1 million question. So the same analogy can be extended for 9B or 45(4). Yes. Sanjeev Bajari, a firm runs an industry with building and machinery. Appearing in its balance sheet, one of the three partners die, and instead his legal heir is admitted. His capital is transferred to the legal heir. Are there any implications? No. There are no implications so long as the capital balance is transferred to the legal heir, then there is no tax implications. Yes. Rajesh Gupta, sir, if rural agricultural is held by the firm as stock in trade, then whether section 9B would attract or no, that would not attract, because as Raji has said, it has to be capital asset. And if you read the definition of capital asset under section 2 clause 40, there is an exception, and that exception refers to the rural agricultural land. And since it is not capital asset, therefore no 9B. Sanjay Goel sir, what shall be treatment in case amount over and above capital balance is given out to the partner by revaluation of assets? So that is what Raji has said, that if it is a case of reconstitution of firm and in excess of his capital, the amount is paid to him, then the firm will have to pay tax on the capital gain under section 45 subsection 4, and that will be calculated in the given example by you is fair market value capital asset less capital balance, whatever excess would be there, that would be capital gain in the hands of the firm under 45.4.
This seems to be a repetition.
Okay. Yes, this is repetition. That's all?
No, we have questions for that.
Okay. How FMV is ascertained? In case of immovable property, can it be valued as per registering authority? FMV may be different for different persons. FMV may not be different for different persons. I could have understood if you had said that FMV in different locations may be different. But then the FMV which is relevant for the purpose of section 9B is, or for that matter for section 45.4 is, that the price which this land or immovable property would fetch if sold in the open market. So no concept of 50C, no concept of the guidance value, no concept of the valuation by the registration authority. It can even be less than the stability value, but then you will have to prove it that its real fair market value is like this. In case of dissolution of firm, there will be no specified entity who will pay the tax. No, if you read section 189, Rakesh ji, section 189 talks of such kind of situations only. So if a firm is dissolved, then for the purpose of making assessment, there is a fiction that the firm will be treated to be alive. Umesh Goel ji, Arey wow, Umesh bhai. At the time of partner retiring, land is revalued and excess is created, then how section 45.4 will be affected? Yes, because when capital account is created with the amount of revaluation, then the capital account which will be reduced should be without revaluation. So suppose if the capital account balance was 100 rupees, by revaluing the land, it becomes 160. So when in 45.4, value of D should be 100 only, not 160. So that is why fair market value of land which is given to the partner minus 100, that will constitute 45.4. Rajiv, please add wherever I falter. Anything you want to add?
No, I just want to say that in case of the amount which is being to the partner in excess of his capital account, then the revalued amount will not be credited to his capital account. Revalued amount will be credited to his capital account only when a certain kind is given to the partner under section 9B. Only then the amount of difference of book value and fair market value will be credited to his capital account. But in case any excess amount is being paid, and for that purpose, as we are running with the example throughout, that 40 is the amount which is in excess of his credit balance, the capital account is being paid, then the revaluation has to be done for the purpose of attribution of this 40 rupees to the existing assets. By revaluation, no amount can be credited to the capital account of the partners.
In fact, Rajkumar, what Umesh ji probably means, you remember in our chartered accountancy days when we used to read a partnership firm's account, when the firm used to revalue the assets, that revaluation amount used to be credited to the partner's capital account. So probably his question is,
the situation is that in case in the earlier years, any partnership firm has revalued the assets and credited the amount to the partner's capital account, that amount will also be ignored. That amount will also be reduced from the credit balance of the credit of the partner's capital accounts.
It has been specifically provided.
Yes, specifically provided. So any amount which has been credited to the capital account by revaluation of the assets will rather be ignored and it will not be credited at all.
Right. Next, please. Like अबे छाजड़ जी अच्छा है अबे भाई बोल रहे हैं भोपाल से like section 48(3), is there any way to claim deduction in respect of stock item given to outgoing partner?
This is exactly the query of Rahul Kanji, we discussed in detail that inventory item has not been prescribed for the purpose of attributing under section under Rule 8AB. It is only the capital asset or depreciable asset has been further added by way of guidelines to mitigate the rigors of the provisions issued by CBDT. But still, inventory item, if there is a revaluation with the value of the inventory, how that is to be claimed by the partnership firm in the later years when it is sold, it is still a gray area which is not yet provided.
So this
In
is
my
a
view,
view
taxes.
given by Sanjeev sir in respect of the interpretation on 45.4.
In my view, tax is to be paid by the firm in place of partner because this tax is attributed to the remaining assets. This may be the rationale of charging tax on firm. So you are putting the cart before the horse. Since the firm has paid tax, therefore the credit is being contemplated by the legislature to be given to the existing firms. It's not the way. It's not the other way around. Arvind
Sorry.
Shah sir. Change in profit sharing ratio will subject matter of capital gain tax and how to compute gain. No, because as we said, Arvind bhai, that unless the capital asset is received or stock in trade is received by the partner, there is no question of 9B. Unless money is received, capital asset is received by the partner in excess of his capital, no question of 45. So in your this thing, since there is no receipt of money or capital asset, therefore there is no question of computing the gain.
Yes, because this is a very common question that change or readjustment of profit sharing ratio without these two things which Rakesh ji has explained, without
Receipt
the
of capital
payment
asset.
in excess of the capital account or without giving the asset in kind, there may be any change of the profit sharing ratio of any partners inter se reducing or increasing the share, admitting the new partner, some partner going, there is no attraction of section 9B and 45.4.
So probably on a lighter side it is there for 9B and 45.4.
No, it's not difficult. It appears in the first blush, Mr. Sahab, that this is difficult. But when we went deeper into it, then we found that it is not that difficult.
Probably in
Sir,
99% of the cases, the rigor of these sections will not be applicable. It may be only in 1% cases that these sections may be applicable.
sir, now we have question from Mr. Rupin Merchant ji. It is in three parts. I'll showcase one by one.
Okay.
Part 1.
5 years back, 10% partner retired. Factory land revaluation done. Amount given to retiring partner to revaluation value. Revaluation amount was stood on capital as reserves and surplus. Then now new plan has been passed and plotting done. Other partners are retiring. They are taking few plots and some amount. There is same circulate when it was 5 years back. So capital gain or business, okay. So this was not related to 9B or 45.4 because I was reading your questions, Rupinji, in that kind of background in my mind that something will be there for 9B and 45.4. This is so again. Somil, rerun, please. Question.
Yes. Part 1.
5 years back, 10% partner retired. Factory land revaluation done. Amount given to retiring partner to revaluation value at revaluation value. Revaluation amount is stored on capital as reserves and surplus. Yes. Now new plan has been passed and plotting done. Other partners are retiring. They are taking few plots and some amount. There is same circular 25 years back. So capital gain or business income, how to calculate tax? Rupinji, I am not clear. You kindly leave your telephone number. I will get back to you. Don't worry. Or you can note down my telephone number 9810420515. You can leave your question 9810420515. Yes, please throw light in case of negative balance in his capital account. Yes, if there is a negative balance in capital account, then that will be added. Apart from money and the value of the capital assets, that will be added, and then that will become the value of A. That is the amount of capital. The amount of capital.
Let me just add here, because this is a very important and significant question from the practicality point of view. Because how to compute, how to see that what is the amount in the credit balance of the capital account of the partner? There can be different components. One is negative capital balance. Another may be certain reserve and surplus are lying. Instead of crediting to the partner's capital account, even only reserve and surplus are kept. Profits or losses are kept in reserve and surpluses. Or there may be certain revaluation reserve by revaluing the assets earlier. There may be certain other kind of reserves which have been created or provisions which have been created. Or there may be current accounts of the partners which are running separately. There may be loan account of the partners. How the amount credited into the partner's capital account is to be calculated. First of all, if any revaluation of assets has been done earlier and revaluation reserve is lying, it is not credited to the partner's capital account, it is fine. It will not be credited to partner's capital account because revalued value of the assets has not to be taken. Number one. If a revalued figure has already been credited to the partner's capital account, it has to be reduced from there, which I submitted earlier also. Then, if there are any kind of reserves and surpluses, either negative balance or positive balance, those have to be credited or given effect in the capital account itself, because that represents the capital of the partners. If there is a negative balance of the capital account, then minus balance of the capital account has to be looked into. If, for example, there is say 1 crore rupees minus balance, and now if you are giving 2 crore rupees, it means positive balance would be only 1 crore, but the taxability would be on 2 crore only, because the amount which is being given to the partner in excess of his capital account credit balance. So now the amount which is being given minus 1 crore is his capital account, but if you are giving him 2 crore of rupees, then the taxability would be, your question is whether it would be on 2 crore or it would be on 3 crores, because 1 crore is minus balance, because minus balance and plus balance is
So capital gain will be 3 crore?
It will be 3 crores. Yes. Taxability would be on 3 crore rupees, because
so legislature's contention to treat negative as zero is only with reference to A. If A comes to negative, then that will be treated as zero. A is equal to B plus C minus D. If the result of B plus C minus D comes negative, then the legislature has provided that will be taken zero. But if D is negative, then negative into negative is positive. Then B plus C, then plus D, negative balance. That would constitute the capital gain.
Yes. Then under section 45(4), taxability would be 3 crores, not 2 crores.
Yes. Any other questions, Somil?
No, sir. That is all with the questions.
So now kindly propose a vote of thanks.
As I say, I think everyone present here would agree. It was truly an amazing and interesting session. I thank Dr. Rakesh, Gupta, Dr. Rasar, and CS Somil sir for this session. I also thank all of you who joined us today for this webinar.
Thank you all.
Okay, thank you.
Thank you.